Good morning and welcome to TOI Japan Market Radio, December 5, 2025. I'm your host coming to you from Tokyo, and this is your daily briefing for global investors tracking Japanese equities, currency, and rates. Let's dive straight into today's market action.
Thanks for having me. It was a broadly risk-off session for Japanese equities today. The Nikkei 225 closed at 50,491.871, down 1.051%, while the TOPIX fell 1.234% to 3,522. Smaller caps showed resilience. The Mothers Index actually gained 2.025% to 2066, but the J-Right Index slipped 0.599% to 1992.5. On the currency side, dollar-yen traded at 155.218, up a modest 0.072%. Commodities were mixed. Gold in yen terms rose 0.613% to 15,595, while crude oil edged down 0.151% to 59.58.
So a clear divergence between large caps and smaller names today. Let's unpack what's driving this weakness in the headline indices. The main story appears to be currency strength and rate hike expectations putting pressure on exporters.
Exactly. The Nikkei fell below the 50,500 level today, and the catalyst was twofold. First, the yen has been appreciating on the back of increased market expectations for Bank of Japan rate hikes. Second, that stronger yen is directly hurting Japan's export-oriented companies, your Toyotas, your Sonys, your Panasonics, because it reduces the yen-converted value of their overseas earnings. This is a critical tension point for Japan's equity market right now.
And this tension is particularly interesting because BOJ tightening should, in theory, signal confidence in domestic growth and inflation. But it's punishing the sector that's been driving profitability.
Precisely. While BOJ normalization reflects optimism about the domestic economy, it simultaneously pressures Japan's most profitable multinationals. A stronger yen erodes their competitive edge abroad and shrinks their repatriated profits. At the same time, higher borrowing costs are starting to filter through the economy after years of ultra-loose policy. For equities, this means large cap exporters are facing headwinds, while domestic-focused names and financials might show relative resilience as they benefit from a steeper yield curve and higher lending margins.
What about the implications for Japanese government bonds and the broader rate outlook?
JGB yields are likely to drift higher as markets anticipate further BOJ normalization. We could see the curve steepen, which increases refinancing pressures on government debt servicing. The key question is how quickly and how far the BOJ is willing to go. Markets are clearly pricing in more tightening, and that's part of what's supporting the yen right now. It's a safe haven bid combined with rate hike expectations.
Staying with the yen theme, let's look at what's happening on the dollar side of the equation. The dollar has been weakening recently, trading near a 5-week low, driven by increased bets on Federal Reserve rate cuts.
That's right. The dollar weakness is a major tailwind for yen strength. As the Fed is expected to continue its easing cycle, the interest rate differential that has supported dollar strength is narrowing. This is crucial for Japan because that differential has been a structural driver of yen weakness for years. When the Fed pivots, the carried trade dynamics shift rapidly, and we see capital flows reverse. That can create volatility across Japanese assets.
How does that play out across Japanese equities and currency markets specifically?
For equities, the impact is mixed. On one hand, yen appreciation is a headwind for export-heavy sectors, autos, electronics, machinery, that have benefited from a weak yen boosting their competitiveness abroad. On the other hand, lower U.S. rates can support global risk appetite, which may benefit domestic-focused Japanese equities and financial stocks. The key distinction for investors is whether Fed cuts are driven by growth concerns, which would be risk-off, or simply policy normalization, which is more benign. For dollar-yen, further dollar weakness likely means continued yen strength, potentially unwinding some of the carried trade positioning that has supported equity rallies this year.
And on the JGB side?
JGB yields may face modest upward pressure if market participants start to reprice the BOJ policy divergence story. However, Fed cuts do reduce overall global rate pressures, so the net effect depends on the pace and magnitude of both central banks' actions. Right now, the market is clearly focused on the narrowing rate differential as a driver of yen strength.
Shifting back to equities for a moment, we also had some important context from overnight trading. U.S. and European stock futures moved higher ahead of the release of U.S. personal consumption expenditures inflation data, which is a key Fed indicator.
That's an important setup for today's session. The PCE reading is critical for determining the trajectory of U.S. interest rate policy, and given how integrated Japan's supply chains are with the U.S. and Europe, movements in global risk sentiment have a direct impact here. Strength in equity futures typically signals improved risk appetite, which can precede shifts in cross-border capital flows and carry trade dynamics involving the yen. Additionally, U.S. inflation data directly impacts Fed policy expectations, which in turn influence the dollar-yen exchange rate and the relative yield differential between U.S. Treasuries and JGBs.
So what should investors be watching for in terms of market impact?
For equities, rising global futures generally support Japanese exporters and cyclical sectors like autos, tech, and chemicals. However, a hawkish PCE surprise, meaning higher inflation, could reverse that quickly, triggering risk-off flows. On the currency side, if we get a softer PCE reading, that lowers Fed rate expectations, which would likely weaken the dollar and strengthen the yen further, unfavorable for exporters. Conversely, a hotter print means higher rate expectations, dollar strength, and yen depreciation, which is favorable for exporters but raises the risk of tighter global financial conditions. For JGBs, market expectations around U.S. policy feed directly into relative yield spreads, influencing foreign demand for Japanese government bonds and potentially steepening the curve if U.S. rates rise.
So really, the PCE print today is a pivotal data point for directional clarity on risk sentiment and carry trade stability.
Absolutely. It's one of those moments where the spillover effects into Japan are immediate and broad-based. Investors need to monitor not just the headline number but also the market's interpretation of what it means for the Fed's path forward. That interpretation will drive positioning in Japanese assets over the near term.
Let's bring this all together for our audience. Today we've seen Japanese equities under pressure, particularly large-cap exporters, driven by yen strength and BOJ rate hike expectations. At the same time, the dollar is weakening on Fed rate cut bets, and we're awaiting crucial U.S. inflation data that could shift global risk sentiment.
That's the big picture. For global investors with Japan exposure, the key themes to watch are the pace of BOJ normalization, the trajectory of Fed policy, and how the yen responds to shifting rate differentials. Exporters remain vulnerable to yen strength, while domestic-focused names and financials may offer relative resilience. And keep an eye on JGB yields as markets continue to reprice expectations around both central banks.
As always, we're not here to give financial advice or tell you what to buy or sell. But if you're a global investor tracking Japanese markets, we hope this daily briefing helps you stay on top of the key drivers. If you find this useful, consider subscribing to TOPIX Japan Market Radio for your daily Japan market update.
Thanks for listening. We'll be back tomorrow with another market briefing.
That's it for today. Stay informed, stay disciplined, and we'll see you next time.